This is Fat Profits Podcast. We're here talking about finance, property, and more. This is general advice. If you're seeking specific advice, please reach out to your professional, or if you'd like to talk to us, please reach out to us at hello@sourcefinancial.com.au. Right, no fluff today. We're here to talk about a few things, because in the last few weeks there have been a series of economic signals coming out that are very telling. We're talking interest rates, inflation, oil, jobs, and recession warnings, and what all of it means for your mortgage and your household and your financial future. This isn't doom and gloom. This is so you can make informed decisions. Let's start with interest rates. This is where people get hit the most, probably for mortgage holders. Mortgage holders make up 40% of the population, so a very small amount. Now, we're recording this at the first week of April. Interest rates have already gone up twice. At the start of the year, a lot of people talked about interest rates going up twice. Once or twice, I said 4. I got called an idiot. But turns out all of us are wrong. This economic position that we're in because of fuel prices and inflation, it's looking like we're going to see another 2 or 3 interest rates on top of what's already happened. So not quite the 4, it's looking at 5. There have even been some economists that have said another 4 interest rate rises. So it's looking like it's going to come up a fair bit. And it's very telling when we look at the bond market, we're already seeing that's already up significantly. So 3 is pretty well a shoe-in unless something significantly changes. And the lenders, they're not waiting. From the start of the year, they've increased their fixed rates onwards and upwards several times already. The banks know what's coming. Headline inflation is currently at 3.8%, and the forecast is to hit over 5.4 plus by mid-2026 in June. That is not a small move. That is a significant decrease. Considering that the lever for the RBA is only interest rate rises, we're not heading anywhere near the floor that we need to be hitting. This cost of living crisis is accelerating. What is driving this? Energy costs, so fuel, supply chain pressure, and building materials. Building materials are set to go up by just 25 to 30% by middle of April. So by the time this episode's come out, it's probably already been impacted. If you're building, renovating, or pricing a granny flat right now, lock in your contracts. But even that might not protect you. It's very possible that we're going to see more builders go bankrupt because they're going to have to do variations to their contracts that may have been signed 6 months ago. But there's going to be no margin, no profit left in the deal. Now just remember that a building contract has over 40% of taxes across GST and other taxes involved. So it's likely your builders are going to come to you, hand out and asking you to a variation on your contract, which also could affect the bank position. The RBA have signalled that they're definitely going to increase the interest rate. So the next time they meet, guys, it is going up at least another 0.25%. But they've said that households are surprisingly resilient. The message here is simple. Variable rate owners need to stress test their repayments now. So what we're saying here, guys, is when you're sitting here and doing your budget, and if you're in a family household, I'd like to think that you are doing your budget every single time you get paid. You should be sitting down with your partner and talking about what does our bills look like. Whatever your current interest rate is, I recommend that you go to the Commonwealth Bank website, go to your home loan repayment, put in what your current interest rate is and plus it by 0.75%, and you should start to stress test your stuff now. Because if you can't afford it, you need to do something. Do you need to fix for a year or two? Do you need to partially fix your loans for a year or two? You need to think about it now. And if you haven't looked at your price on the interest rate, time to do it, because once the interest rates start going up significantly, you might be locked in. You might not be able to refinance or change your interest rate. You might not be able to afford it. You need to start doing it now. It's a wild card. It's the uncontrollable, but what you can control is start thinking about it now. Now, if oil hits $200 a barrel, and there's credible analysts that are putting this on the table, the flow-on effects would be devastating, not for Australia, but for the global economy. The cascade effects are a few things, and I'll read off this piece of paper like I have been doing most of the episode. Fuel prices spike. Everything that moves on a truck gets more expensive. Groceries, tradies, logistics, manufacturing, all priced upward. Inflation doesn't just stay elevated, it will accelerate again. So the 5.4, we're only talking about the last 3 months, guys. If this happens, it's going to exceed 8%. Exceed it. Central banks face impossible choice. More rate hikes, which is a definite shoe-in at this stage, to fight inflation, which they won't be able to fight it. Or some of the things that have been thrown out there is they might cut the rates to protect growth. So this might mean that they drastically reduce interest rates so they can put more money into the economy to keep things moving. Working from home becomes an economic necessity, not a lifestyle choice. Unemployment rises as business cut costs to survive. It's highly possible that happens, guys. We've already seen that what fuel costs do to international budgets at current prices at $200 oil. We are talking about a fundamentally different cost of living. And here's the question I want to ask you is your household positioned to absorb that kind of shock? Have you looked at it? Have you looked at the budget? Have you looked at if your prices increase, if grocery prices increase by 30%, if interest rates increase by 0.75%, have you looked at your budget and can you absorb that position? And what does it look like for you? What do you need to cut out of your budget now? What do you need to do? Because planting a strawberry tree isn't going to change your bills. You're not all going to be homesteaders. We need to think realistic here. Now let's talk about what some of the institutions are saying. I'm not going to go through every single institution, but Westpac just last week has warned there is a chance for a recession driven by inflationary pressures, which was already bad before the fuel crisis has happened. In international tensions, economists are flagging for a potential weakest GDP growth since the early 1990s. I don't know what you remember. I was a young kid, but in the 1990s, we didn't have a very good economic landscape in Australia. The S&P and ASX 200 closed at 1.06% in recent trading to 8,579, part of a broader pattern of volatility that's rattling investors' confidence. $1 billion sale of a retirement living operator has suspended directly due to small turmoil, and corporate travel costs are rising. Companies are changing strategy to flow through to ticket prices for everyone. So another thing that's probably going to affect mortgage holders as well, it's not just the price cost and the increase of the cost of debt, but there's a lot more mortgage fraud happening. We saw the Commonwealth Bank had over $1 billion, they believe $1 billion in mortgage fraud through particular individuals, where AI was creating pay slips, generating statements, and they're concerned because of the cost of living pressures that this is going to be increased because people aren't going to be able to afford loans. The ACCC has warned the Big Four banks to lift their game on mortgage due diligence following a widespread loan fraud scandal. And it's been multiple banks, not just Commonwealth Bank. Translation, we're going to expect higher scrutiny on applications. They're going to look at things more closely. They're going to put in more tech to look at these things. It might push forward open banking a little sooner. Lenders are about to get more conservative. If you're planning to borrow, get your documents in order now before the window tightens. Card surcharges. You know what? I give him a hard time, but this is probably the only good thing Jimmy Chalmers has brought into effect is he's basically telling local businesses and the banks that there are going to be no more surcharges on the card expenditure. That's going to be gone. It doesn't come until October. Don't know why we have to wait that long. It's a big cost but some small businesses absorb that and don't pass it on to the customer. Will it actually change things for the consumer? Probably not. The base costs will probably just increase anyway, but it's one good thing that they brought in. Unemployment. This is the one that people aren't really thinking about yet or talking about yet. It's a likely thing if the barrel of oil hits $200. Particularly in the tech space, we're seeing a huge layoff. Atlassian had 1,600 jobs being cut directly because of AI efficiency. I actually had a friend of mine that I know got cut from Atlassian. Very smart guy. 16,000 roles cut globally from Amazon, and Meta is expecting to reduce headcount by 20%. And there's been more that have come out since I've wrote this as well. These aren't companies that are struggling for profitability. We're going to have that issue as well. We're going to have companies that are cutting staff because of profitability. These are companies cutting because AI can do the work cheaper. So we're coming into a time where AI can be doing more. The cost for AI is significantly cheaper than a staff member. You don't have to think about a staff member's feelings. And in addition to that, you might see some companies also try and relieve some of those pressures. So it could be a little bit of a storm in a teacup here. All right, so we've laid out a bit of a picture. There's lots and lots happening. I've regurgitated and rambled a whole bunch of things. You've seen me looking down for half of the episode. There's just so many stats to talk about. It's confronting and it's doom and gloom, I know. But here's the thing. Every person who has built wealth through downturns did one thing differently to everyone else. They prepared before the crowd did. Because there's going to be opportunity. I just talked about interest rates potentially being cut. Well, your borrowing power is going to go up. If you've got your job, you've got the cash, and the property prices aren't likely to crash. They said this during COVID, they were expecting a 30% crash. There's no evidence, even now, that they're starting a downturn starting. There's going to be opportunity. Your existing properties, if you have one, are going to grow. If rates cut significantly, you're going to be in a position where you can take out equity. Yes, the banks are going to have tighter restrictions, but there is an opportunity here to keep buying because guess what? You're going to have cheaper debt for a period of time. Yes, you may need to sell some things as rates go back up again if there is a cut. There's opportunity here to snag some pretty cheap growth with cheap debt. Number 1, your action list as of right now is to review your interest rate. If you're variable, stress test it at 0.75% above your current interest rate, and can you absorb it? Do you need to think about refinancing and talking to a mortgage broker just to get the rate cheaper anyway? And do you need to consider fixing portion of your loan and keeping a portion variable for cash savings? Lock in building contracts where you can, though I don't think this will do much. I do think if the build costs in April go up 25 or 30%, and if fuel keeps going up, it's going to go up higher, I do think that the builders are just going to come to you and do a variation and possibly just cancel the contract, guys. I think they're just going to go bankrupt. I don't think that they're going to absorb that. If they're doing 10, 15 projects a year, 30% across a lot of them is significant, guys. So, but where you can, maybe for a smaller build or a smaller project, lock in your contract as soon as you can. Look at your discretionary spending. Put it down on paper every single pay. Review it. What can you cut? What expenses can you get rid of? What lifestyle thing can you get rid of for a period of time? Can you cut $800 to $1,000 out of your budget? Know your borrowing window. Talk to your broker. If you're planning on buying an investment property, or even worse, you've got a pre-approval in and you're trying to find a property and you've been waiting. What happens if the interest rates go up again next month? Can you still borrow? Because that's going to change every month. Your borrowing position will change. Until rates go down, your borrowing position will continually decrease. Look into it. Know what's happening. Build a buffer. Try and build 3 months of expenses. Are there things in the house that you can sell immediately? What's the lowest hanging fruit? How can you build a buffer into your bank account right now? Don't panic sell. The investors who panic usually have trouble getting back into the market. They regret it. Can you be strategic and sell? You should be selling for one to build a little bit of security, but you shouldn't panic sell everything. If you got 5 properties, sell one. If you got some shares and they've gone down and you bought when they were higher, maybe it's time to buy some more. Buy while it's lower. But don't panic sell. Sell for a purpose. Stay the course on quality assets. Last one, upskill. Is there second jobs? Do you need to learn more about AI? Are you a business owner that does everything manually? Do you need to consider automating this? Because this will fast forward in 5 years. If you don't get across this, you'll be left behind. The economic environment is shifting fast. I literally recorded episode 4 weeks ago and I feel like it's almost not even great to let out because this will supersede it. But shifting environments create opportunity for those who are ready. All right, 3 things to remember today. Rates are going to get higher. Inflation is going to get higher. Expenses are going to get higher. You need to know your numbers. The signals are there. Westpac and other institutions, the ASX, the job cuts. This isn't speculation. It's actually happening right now. Preparation beats prediction. You don't know. You don't need to know exactly what happens. You need to be ready for it. The other thing of what I think will happen is I do think we're going to continue to have access to fuel. I don't think that's going to go anywhere. We're still going to be able to go do our things. Those of you that need to work from home will have to work from home. But costs are going to go up significantly. Those are the guarantees. Will interest rates cut? There's a few things speculating that. But in the meantime, stress test yourself and get prepared for more interest rate rises. That's Fat Profits headlines. If you think this episode's good, share it. If you'd like to talk more, please reach out to us in your DMs. If you'd like to have a conversation with what your current interest rates are and as if there's anything we can do for you, reach out.